Yeah, hi traders. Obviously, after all the intrigue, all the debate, all the speculation, all the position that's gone into this, the Fed meeting is now firmly upon us. This is obviously a meeting, it's a huge event risk that we need to manage our exposures across. We've got to look at our positioning, how exposed over the meeting. Could we see high volatility playing through? These are all factors that we need to consider as traders going forward. And devising a playbook to see where the balance of risk sits it's essentially quite problematic, because you've got five major components to this. First of all, you've got the 25 versus 50 basis point debate, and the outcome of that could see some initial spikes higher up or lower in the dollar, risk assets, gold. All these factors may come into, may see some very, very lively moves initially. Then you've got the Fed's statement, and of course, the tone of that comes through, and how dovish that reads, how concerned, that statement reads, or how constructive it reads. It could set off some moves in markets as well. We've got the new statement of economic projections, new set of dots, and of course, 30 minutes after the statement drops, we get Jay Powell, the Fed chair, stepping up to the press conference, and of course, his wording and his choice of words may guide the market as well. So, of course, when you've got these major components playing through, it's difficult to make that playbook. And of course, the first move that we see after the raise decision may not be the final move, and it could get quite violent and whippy within the market as liquidity comes out and we see positioning unwound very, very quickly. Now, we have a look at that first debate. Of course, it's the 25 versus 50 basis point decision, and that's where you're going to see the initial move. I'm not really putting too much weight to where economists are calling, because, whilst most of them have got 25 basis point cut being penciled in, a lot of those calls were before we saw the Wall Street Journal article, the FT article, and Bill Dudley's opinion piece in the Bloomberg as well. So certainly I'm not putting huge amounts of weight to that. And there's a couple of people still calling for a hold, and I wouldn't be listening to a word they have to say, because either they're not listening to what the Fed have to say, or these are legacy calls from way back. But in terms of where the market's positioned, we've got to look at swaps pricing. We can see that we've got 39 basis points of cuts being priced in for the September meeting. That obviously gives you about a 56% chance of a 50 basis point cut. Now, I will say that swaps have been very, very violent and very volatile in the last week or two as people try and find that fair value. And I think we're probably settling at that fair value at the moment. But because the market is seeing it as a line ball call, we could see some initial moves, very, very violent moves in the dollar, in gold, and the NASDAQ, depending on the outcome there as well. Now, if we go further out the curve, we can see in swaps pricing, we've got 115 basis points of cuts by December. We've only got 3 meetings till the end of the year. So essentially, we're going to need to see 250 basis point cuts coming through and 125 basis points to sort of meet that pricing. And I think also, if you go into SOFR futures and have a look at what I think is quite interesting, is what I use is very much a sort of a recession tool and what the market's thinking there. You can see that we trough out in March 2026 at 2.8%, which conveniently is exactly where the Fed's long-term neutral rate is. So in my mind, the market is saying that we're going to get down to the longer-term neutral rate, we're going to think about it, and then we're going to start a new business cycle as they start hiking again. And that tells me that the market is saying that we've still got this soft landing very much in the central case. And if we were to see that low in yield pushing through 280 and specifically through 250, that would tell me in the future that the market is seeing fragility and we're getting closer towards recessionary environments with the Fed needing to take it through neutral into a more stimulatory capacity. But we're not seeing that at the moment. But I'm using SOFR futures to define that going forward. Now, in terms of the SEPs, or the Statement of Economic Projections, we're not expecting any changes to their GDP forecast. We're still expecting them for about 2% for next year and 2% for 2026. The unemployment rate for this year may be tweaked a little bit to 4.2% from 4%. And then for next year, that should be kept around sort of 4.2% as well. In terms of core PCE, in terms of inflation, we're expecting that to drop to 2.6 from 2.8%. So, modest, more constructive tweaks a little bit to the downside. And then for next year, we're expecting to take that down to 2.2%. So getting closer towards that target. In terms of where they are on the dots, I think they're going to take those down, but it really depends on whether they cut by 50 or 25 basis points at this meeting. If they do cut by 50 basis points, then one would expect that dot for this year to be taken down to 4.4%. And then for next year, which is quite interesting, probably take that down to about 2.9%, which would imply 150 basis points of cuts for next year, or 25 basis points cuts, or whatever increments they do it. And that long-term neutral rate should be kept at 2.8%. Obviously, if they only cut by 25 basis points, then that dot should be taken down to 4.6%. And then for next year, 3.1% as well. So again, there's still going to imply 6 rate cuts coming through next year. Now, where does the balance of risk sit with the dollar and risk assets more broadly, given these dynamics? Well, some people have said if they cut by 50 basis points, that's going to be a very positive affair because of a risk-on situation. Some other people say if we cut by 50 basis points, it might send alarm bells ringing and we may see de-risking. I sit in the camp that it really depends on their messaging. And the tone of the voice, and why they've decided to cut by 50 basis points is arguably the most important factor here. So if they do cut by 50 basis points, because of insurance policies to try and get ahead of the curve. But they still come up with a fairly constructive tone that they're very much in control of their destiny, that they're driving the situation. The labour market's cooling, but it's kind of expected. You know, you could see a strong risk-on rally playing through, especially if it coincides with an appetite to cut again by 50 basis points, depending on the data, and we could certainly see that. However, if they cut by 50 basis points, but there's a more sort of a nuanced but concerning factor around the labour market, and that, you know, they're seeing signs of worry, then you could see a big de-risking playing through. So it really depends why they cut 50 basis points and the tone that comes through in the statement and in Jerome Powell's testimony as well. We know Jerome Powell's dovish, she's more dovish than most members, but it's that level of concern that the market's going to be feasting on. Conversely, you know, if we get 25 basis points cuts, you could say the market might be disappointed by that situation. We might see the dollar rally and, you know, the NASDAQ going under pressure and gold having a bit of a move as well. But again, it really depends on why they've chosen to start with a smaller cut. Because if they come out and, you know, with 25 basis points, but they give a constructive outlook and give an appetite that they may go 50, depending on the data, if it needs it in the November or December meeting, then we may see the market looking to buy that initial pullback in disappointment and then go on a strong rally as well. So for me, all of these factors really determine why they're doing it and the level of concern. I think, you know, it really doesn't matter to me mainly, and it's a superficial issue, why they're cutting by 50 or 25 basis points. The market's going to be feasting on the tone. That to me is where the balance of risk comes through.